my take on the famous Dosa economics, which was coined by ex-RBI Governor Raghuram Rajan. Along with this, I have my own explanation about Dosa theory in a different way. Inflation. In next few minutes, there will be no confusion. 2022 has been a strange year when it comes to inflation. In June this year, US reported an inflation rate of 9.1%, which is the highest inflation rate in 41 years. That's right, highest in 41 years. UK and Europe also recorded an 8.8% and 8.6% inflation rate in June 2022. Sri Lanka. Yeah, that's right, the most talked about country, hit a record of 54.6% overall inflation rate and an increase to 80.1% in food inflation. The annual inflation rate in India reduced to 7.1% in June, from 7.4% in May, but still above the RBI's target range of 2 to 6%, something it has been aiming for since the beginning of 2022. Naturally, all major economies are making efforts to control this inflationary pressure. In May 2022, in a rather unscheduled manner, RBI announced a hike in interest rates by 40 points or 0.4%, and in a span of just 1 week as on 8 June, raised it further by 50 points to make it 4.9%. This was followed by the US Federal Reserve hiking rates by 75 points on June 15, taking it to 1.75%. Both hikes were on expected lines, but the US hike was the biggest since 1994. That's right, this is quite a major move, biggest hike in 28 years. And there is a likelihood of further increase in the upcoming months as there is a 40% likelihood of upcoming recession in US. So, what does this rate hike mean for investors? For the common man, what is inflation, its causes and ways to overcome it for everyone? And we will going to explain very interesting topics like in India, inflation rate is 7%, and interest rate or the repo rate is 4.9%, whereas US reported inflation rate as 9.1% and hiked interest rate to 1.75%. Why is there so much gap in US than India? Friends, all of this matters and all of it matters to us. So, we are sharing with you some key information based on the in-depth research by our team. First, we talk about inflation, the causes, the way it's calculated, the mechanism behind inflation, and then steps to overcome it. And we are going to prove some miscalculation and wrong assumptions on understanding the inflations or economics. I'm gonna share my take on the famous Dosa economics, which was coined by ex-RBI Governor Raghuram Rajan. Along with this, I have my own explanation about Dosa theory in a different way. So please, watch till the end to create wealth and beat the inflation. So, firstly, what is inflation? Inflation is simply a sustained increase in the prices of goods and services. With an increase in the level of prices, the value of money goes down. To put it simply, in an economy, when the level of currency or the amount of money in the market exceeds the level of production, inflation occurs. This is due to existing monetary policies of that economy. It's all a cycle starting from fiscal policies. For example, government financial policies related to borrowing and spending. So, higher borrowings or debts results in higher taxes and additional currency printing to repay the debt. And so monetary policies or policies by the central bank of an economy work around that. And all this currency that has been printed is also exposed to foreign markets, where exchange rate becomes an important factor. and thus fluctuations in the exchange rate have an impact on the change in prices. Inflation is there for everything. This can be for all consumed common products and services such as food, clothing, housing, entertainment, transport, consumer staples, or even industrial goods. For example, the price of tomatoes in Hyderabad were 20 rupees per kg in June, but after 1 month, the prices were doubled to 40 rupees per kg. So we can call this as inflation. In July, we got 500 grams of tomatoes, whereas in June, we were able to buy 1 kg of tomatoes in 20 rupees. This is the fall in purchasing power of money. In an economy, every product will have its own inflation rate and change in that inflation rate. But the interesting or surprising part is that inflation is not same. It varies for different regions, sectors and economies. For example, the land values in Hyderabad may have 20 to 30% appreciation per year, whereas in US, we have seen the price appreciate up to 5% per year. Similarly, the prices of vegetables or electronics will have the different inflation rates which will not be constant or same for everyone or every year. For better understanding, our government has simplified the calculations by calculating an average inflation rate. We have to understand the inflation is a very common thing. Prices will change, but the rate of change or growth becomes a worry for every economy because it's dependent on various external factors as well. So, it can change to abnormal rates like 2% to 8% or to 400%. There are 3 types and 4 forms of inflations. Let's talk about the types first. There is demand pull inflation, cost push pull inflation, and structural inflation. Demand pull inflation happens when aggregate demands exceeds aggregate supply. Imagine what happened when there was an outbreak of COVID virus in India. Due to the outbreak of COVID epidemic in India, the government notified a warning that people should wear breathing masks to protect them from the infection. As a result, the demand of masks had risen to a very high level, but the supply was limited as the producers of the mask had no anticipation of the COVID epidemic. Due to the high demand and limited supply of masks, the prices had risen crazily. Due to COVID, many countries then pumped money into the market to meet demand expectation for higher consumption, and this has led to abnormal rise in inflation in short time. So first was demand pull inflation. Second, cost push pull inflation. So, sometimes cost of any product increase as much as cost of production of the raw materials and services. This is primarily due to 3 scenarios. First scenario is a wage push inflation. That is, when there is a rise in employee wages due to whatever circumstances that increases the production cost, and the burden of this higher cost is borne by the customer in the form of higher prices. Next is the scenario of profit push inflation. Some companies want to increase their profit margins, so they simply raise the prices. So in one scenario, we talked on higher labor cost, and in the last scenario, we talked about raw material push inflation. So when the raw material costs rise, the cost of making the product will also rise, and this burden will be borne by the customer. Best example for this type of inflation would be the rise in edible oil and sugar prices. Because of these key raw materials, prices of sweets and other snacks will also rise. After covering demand push and all scenarios of cost pull, we are coming to structural inflation. This type of inflation is prevalent mostly in developing and low-income countries. Many times it is considered as the inflation which occurs due to some technical or geopolitical issues. For example, Due to the Ukraine-Russia war, the prices of major products in Ukraine and Russia have risen. Let's not forget the 4 forms of inflation after discussing the 3 types. These are hyperinflation, deflation, galloping, and creeping inflation. Hyperinflation occurs when prices skyrocket by more than 50% per month. It is very rare. In fact, most examples of hyperinflation occur when governments print money to pay for wars. Examples of hyperinflation include Germany in 1920s, Zimbabwe in 2000s, and Venezuela in 2010s. Next is deflation. Deflation is the opposite of inflation. It's when prices fall. It's caused when an asset bubble bursts. Don't confuse this with just discount on products. This is a disaster for the economy. That's what happened in US housing market in 2006. Deflation in housing prices trapped those who bought their homes in 2005. In fact, the US Fed was worried about the overall deflation during the recession. That's because deflation can turn a recession into a depression. During the Great Depression of 1929, prices dropped by 10% per year. Once deflation starts, it's harder to stop than inflation. After hyperinflation, let's talk about creeping or mild inflation. This occurs when the prices rise by 3% or less per year. According to the Federal Reserve, when prices increase by 2% or less, it benefits economic growth. So this is a fairly optimal form or phase of inflation. Lastly, let's discuss galloping inflation. So, when inflation rises to 10% or more, it creates absolute havoc in the economy. Money loses value so quickly that businesses and employees' income can't keep up with costs and prices. Foreign investors, in turn, avoid the country where this occurs, depriving it of needed capital. The economy becomes unstable and government leaders lose credibility. Galloping inflation must be prevented at all costs. So after discussing what causes inflation, including the types and forms or phases of inflation, let's understand how inflation is calculated. But before that, we have to understand the 2 main sets of inflation indices. That's right, WPI and CPI. In India, there are 2 main sets of inflation index for measuring price level change in India: the Wholesale Price Index and the Consumer Price Index. WPI, as the name suggests, measures wholesale prices and was used by RBI to make monetary policy until 2014. The Wholesale Pricing Index is the weighted price of a typical basket of 697 wholesale items. Next is CPI or Consumer Price Index. This is a measure of price change at the retail level that is based on 260 commodities, including goods and services. From 2012, due to the influence of ex-RBI Governor Raghuram Rajan, CPI has been used to calculate and report inflation. When we say retail inflation, we are talking about CPI inflation. This retail inflation as prices are collected from retailers. In India, these prices are collected by Ministry of Statistics and Program Implementation and Ministry of Labor and Employment. They collect prices for different sectors and construct the figure of inflation. Coming back to inflation calculation, I like to refer as the percentage rise in prices per year for the whole economy. And the formula is inflation rate equals to B minus A divided by A multiplied by 100, where A is the initial cost of last year price or last year CPI, B ending cost, this year price or this year CPI. CPI, as discussed earlier, is constructed based on weighted average of price in all sectors. So when inflation rate is calculated and reported, it is the average inflation rate. Earlier we talked about fiscal policy, monetary policies, and exchange rate as factor for inflation. Friends, please don't forget to watch this video till end. I am sharing basics about inflation to reveal the misunderstandings while understanding the inflations and what should the common man and every investor do to fight the inflation. So do like and share this video and subscribe to this channel for understanding about our economy in depth. Now we will try to explain a real mechanism. The money supply in an economy is controlled by the central banks. In the case of India, it's RBI. Whenever there is a threat of inflation, the central bank intervenes to control the money supply to control the inflation. The mechanism through which the central bank controls inflation depends on interest rate. Interest rate and money supply moves in opposite directions. As money supply or the currency in the economy is increased, the interest rates have the tendency to fall and vice versa. But why does it happen? Suppose at any given point in time, the economy is suffering from low growth. The central bank intervenes by using its monetary policy tools. For example, bank rates, repo rates, statutory liquidity rates. The result of such loose monetary policy will increase the money supply in the economy. The increased money supply means at any given point in time, there will be excess money in the economy than what the people are willing to hold. What will happen to this excess money? People will not want the excess money to be kept idle in their wallets, so they will try to invest it in alternative financial instruments like stocks, bonds, gold, real estate, etc. As a result of this, the demand for financial assets will increase, which will lead to increase in the price of these assets. An established relation in financial economics is, as bond price rises, interest rates will fall. A fall in interest rate leads to an increase in investment leading to an increase in output, which eventually leads to an increase in employment and national income. Hence, end of slowdown. Let's understand this better by the famous coin term Dosa economics by ex-RBI Governor Raghuram Rajan. Dosa economics remains the only economic theory that makes our mouths water every time we discuss it. Unfortunately for us, the theory has very little to do with us eating dosas immediately. Former RBI Governor Raghuram Rajan served during a challenging time when the interest rate offered by banks were high, but at the same time, the inflation rate was high too. Although quite a few of his decisions were unpopular, looking back, they served in the best interest of the economy and curbing the rise of inflation. One of his decisions, which received a lot of flack, was reducing interest rate on fixed deposits from 10 to 8% when the inflation fell to 5%. This decision received criticism from many citizens, as FDs are still a popular investment option throughout the country. In addition to this, FD income is a part of many senior citizens' source of income or the only source of income. When questioned as to why he took such a decision, Mr. Raghuram explained using something called Dosanomics. In simple terms, if someone has 1 lakh rupees, he will be able to buy 1000 dosas each at rupees 100 in 2021. But with 10% inflation, each dosa cost is now rupees 110. So he or she would be able to buy 909 dosas only instead of 1000 dosa in 2021. Meanwhile, if he or she has a fixed deposit which can give 10% returns, then he could buy 1000 dosas as he will have 10% return from FD. In some cases, the inflation will be more than the bank interest rate, and in few cases, interest rate is more than inflation. If it remains the same, there will be equal impact. However, if we are able to get better interest rate than inflation, then it will be useful to common man. Raghuram Rajan had worked the best to minimize the inflation rates in India. Can see this image. During his tenure, He lowered the inflation rates from 9.5% to 4.5%.